If you made $10 million, would you be able to get away with paying $0 in taxes? In this video, I'm going to walk you through the exact process I would take to help a client making $10 million annually to paying $0 in taxes in only 4 moves. After spending hours researching people like Musk and Bezos and Buffett and seeing how little they pay in taxes in comparison to how much they earned. Now, before we get into the strategies, I want to be clear that this is just a scenario. Depending on your goals and financial situation, a plan like this would have to be adjusted. But I do want to let you know that this just shows the power of what is possible. So with that said, let's get to planning. Now, when I work with clients, the first thing I do before I create their tax plan is that I want to get a feel for what exactly is going on with them financially. So we're going to do the same thing with our client that we're going to call Michael. Let me give you some facts about Michael. Michael is an entrepreneur. Michael is a business owner, and he is the sole income earner in his household. He and his wife have 2 high school age children. Michael does about $10 million in revenue in his business and takes home $3.5 million in profit. He is taxed as an S Corp and has a salary of $500,000. And then based on this scenario, his tax bill for the year, before we've done any strategy or any planning, would be about $1.33 million. So now that we have the facts set, it's time to get into planning. When I work with clients, I always start with easy to implement strategies first. Number 1, it gives a quick win. 2, it usually is relatively easy to set up, and it is also relatively easy to manage and maintain. So this plan is no different. Strategy number 1 is that we're going to implement a retirement plan. For this scenario, I've selected a solo 401k, but there's always other options. You can look at defined benefit plans, you can look at SEP IRAs, or some other type of retirement vehicle. The max contribution for 2025 is $70,000. And so for Michael, we are going to max it out. So we asked his wife if she's willing to work for the company, and she said yes. Welcome to the team, Diane. And so we are going to now put her on salary, paying her about $25,000 a year, of which $23,500 is going to be allocated to her own solo 401k. Additionally, because she's now an employee of the company is also going to contribute an additional $6,250 to her retirement plan on her behalf. So total taxable income that has been saved with just one strategy is $99,750. That equates to almost $37,000 in tax savings with just one strategy. Now, we've got a long way to go, but we're already making progress. The next strategy that we're going to implement is something called creating a family management company. With this company, we're going to oversee Michael's existing business, and we're also going to create an advisory board. This is where the kids come into play. They're not going to serve in the advisory board, but they will be employees of the family management company. We'll also hire an advisory board, which is going to have Michael, his wife Diane, and whoever else he thinks is appropriate to serve on that board. This strategy will reduce taxable income by a minimum of $35,000, equating to $12,950 in tax savings. Now, before we get to the rest of the plan, I want to make one thing clear if it's not already. These are strategies that anybody can implement. You do not have to have a whole lot of money to start your own retirement plan. You also don't have to have really any money to start a family management company. You just have to understand how to use these to your advantage. So if you're not already doing this, I'd highly recommend that you do. With that being said, let's get rid of the rest of these taxes. Now, strategies 3 and 4 are going to require capital. So these are for accredited investors and people with high net worth. But again, we're just trying to show what is possible when we are proactively tax planning. So strategy 3, we're going to invest in oil and gas. Now, there's the concept of oil and gas investing in mineral rights is beyond the scope of this video. But what I do want to say is that when you invest in mineral rights, you not only get a tax deduction, but you also get a return on investment with the money that you invest in this strategy. So with Michael, he is going to invest $693,000 with a qualified producer, and that investment is going to give him a $230,000 tax savings. It's also going to, as I said, generate income for him over the next several years. Strategy number 4 is that we will look for a commercial building and perform something called a cost segregation. This building is going to be used for Michael's headquarters for his company. Now, let's assume that he's able to find and purchase a property that's worth $10 million. What I've seen in practice is that about 40% of the purchase price is able to be accelerated and taken in the year of acquisition using something called bonus depreciation. Assuming that Trump's big beautiful bill gets passed, that would mean 100% bonus depreciation taken in 2025 on that purchase. And so with this strategy, we have now managed to wipe out all of Michael's income. Now, I would have you to note that we could have just used this one strategy, but it all just depends on what you'd like to do. And as a reminder, the bill has not been passed. So as it stands now, you're only able to take 60% to bonus, and we want to make sure that we're getting rid of all the income, so we're layering on some other strategies as well. So there you have it. We've gone from $1,327,269 to $0 in taxes. If you found this video helpful and you'd like to learn more about tax strategy, I think you'll like this one as well.